All right, everybody, welcome back. What we just did in this class for you folks at home is we did a quiz over adjusting entries, Chapter 3 adjusting entries. Real quick, going to the Elmo, this is what the quiz looked like. Now, this quiz is in your blue student manual, people at home, okay? So, even though I cannot collect this quiz, or you can, I can't keep you from looking at your notes and your books, you can come off that now. Go ahead and take that quiz just like it was a regular quiz, and we will go over that next class period after I've graded your quizzes. Does that make sense? So you folks at home, go ahead and do that, because I want you to have an idea if you know what you are doing. All right? Secondly, another thing that you will find, folks at home, in your blue student manual is the solution to problem 3-2B. All right? I handed that out to you folks. That will be in your blue student manual as well. That was the problem I assigned if you want some extra work, but you don't have to do it. Okay? All right. We are getting towards the end of this. Well, we're done with Chapter 3. We're going to start Chapter 4 today. I anticipate that we will spend this lecture, the next lecture, and then one more lecture on Chapter 4. And then we will be done with the section over Chapter 3 and 4, and then it will be test time. Okay? So I want to give you a little idea. I know in some ways it seems like we just had a test, doesn't it? But the second one comes up a lot quicker. Okay? Because Chapter 4 is actually pretty quick. All right? Okay, any questions on anything? Okay. All right, what I want to do now then is go to Chapter 4. And we are going to start this process called closing entries. All right? So, everybody should have the Chapter 4 PowerPoints, is that correct? For you folks at home, I emailed these to you. This is called Completing the Accounting Cycle. And we're going to actually have a homework problem sometime in this section where we take a look back at the whole accounting cycle to make sure that we understand it. Okay? Now, the process we're going to talk about in this chapter is called closing entries. Have you ever heard somebody say something like, oh, work is really busy, we're doing the closing process now, or we're closing out the books? You ever heard that term, perhaps? This is part of the stuff that they do in that process. Okay? Let's go ahead and dive right into it, okay? The closing process. What we are going to do is we are going to reset the revenue, expense, and withdrawal account balances to 0 at the end of the period. And we're going to kind of summarize, you'll see, the period's revenue expenses into an income summary account. Okay? Now, this states that we need to identify the accounts that are closed. We need to record and post the closing entries, and then what we're going to learn how to do is prepare a post-closing trial balance. Okay? Coming off that Elmo now, back to me. Has anybody ever had a job where they were paid commission, like on how much sales they had? Anybody? Gil, what'd you do?
I worked at like a men's dress shop, suits, sold suits and stuff like that.
Okay, so do they just keep track of how many you sold?
Mm-hmm. There's a whole, just on a computer, there's a list of if we sold a tie or pair of socks, suit, whatever.
All right, good. Anybody else? I had a student once who sold used cars. Okay, and what they would do is they would have this whiteboard hanging in the office with each salesperson's name written at the top. And every time they sold a car, they would list out that car and how much they sold it for. Make sense? And they would do this for each month. And then at the end of the month, they would calculate what sort of commissions the person made, and they'd pay it to them. Okay? What do you think they did? What do you think they did the first day of each new month? They erased the board, didn't they? They erased the board. Okay? And that's kind of what we're going to do with the closing process. If you looked at the financial statements for, say, Sprint, and you looked at the income statement, it would not show you the income and expenses accumulated since they started the company back, what, 100 years ago or when, I don't know when Sprint started, okay, long time ago. It wouldn't show you the total revenues and expenses since they started the company, would it? They just, and we kind of understand that, we're not surprised, they just kind of start over at the beginning of the year, and the revenues and expenses start at zero and they accumulate again, right? Now that's because revenues and expenses are what we're going to learn are temporary accounts. They are closed, okay? Now there are some accounts that are not closed. They are not zeroed out at the end of an accounting period. Examples of those would be permanent accounts. Liabilities, assets. Brett, if you had at the end of an accounting year, if you had $3,200 in your checking account for your business, when you come in January 1, you're still going to have that $3,200, right? Okay. Peter, if your business has a note payable of $14,600 at the end of a day of an accounting period, when you come in the next day, is that going to be zeroed out and you don't owe anything? No. The liability is still there, unfortunately, isn't it? Okay? So some accounts are closed, some are not. Let's talk about that. Because the first step really is to identify which accounts are closed and which accounts are not. Okay, we classify accounts as either temporary accounts or permanent accounts. We only close temporary accounts. What are the temporary accounts? Well, we talked about two of them. Revenues and expenses. All revenues, all expenses are temporary accounts, okay? That means we close those out. Another account that is temporary is withdrawals, owner withdrawals, okay? We zero or close that out at the end of an accounting period. And then there's another account that you don't know yet, and we'll talk about it today, called income summary. And that is a temporary account that we close as well. What are our permanent accounts? Well, as I said, all your assets, all your liabilities are permanent accounts. We do not close them out. Another account that is a permanent account is the owner's capital account. We do not close out owner's capital. Okay? So, questions on that? All right. Now, there are 4 steps to recording closing entries. And I wish we could have these 4 steps up on the screen, and then there was another screen where I could show you what they look like, but because of the logistics of the class, we can't do that. So what you might want to do is, everybody should have the PowerPoints. I want you to look at these 4 steps while I kind of illustrate what they look like, okay? The first closing entry is to close the revenue accounts to income summary. The second closing entry is to close the expense accounts to income summary. The third closing entry is to close the income summary account to owner's capital. And then the fourth step is to close withdrawals to owner's capital. Okay? All right, let's take a look at what this is going to look like. Okay? Now I'm going to go over to the Elmo. But keep that slide that we just looked at in front of you. All right? Let's see here. Okay, the first closing entry is to close the revenue accounts, right? Now, revenue accounts, are they a normal debit or normal credit balance accounts? They're normal credit balance accounts. For example, let's say you look at your ledger and you have consulting revenue. And let's say the consulting revenue has a balance of $33,000. And maybe you have miscellaneous revenue, and that has a balance of $2,000. Okay? Now we need to close those out. We need to zero those out. How would we zero these accounts out? What would we have to do to them? We would have to debit them, correct? We would have to debit these things. If we want that to have a zero balance, we've got to debit it for whatever is in there, and that's how we close it out. So our first closing entry, what we are going to do is we're going to list out each revenue account. Now I'm just putting revenue to specify your different revenue accounts, okay? And we are going to debit those, okay? And then the debit, the offsetting credit will be to this account called income summary. So let's say the total of all your revenue accounts is $80,000. Okay? Now take a look at that entry. Couple things. You have to list out every one of your revenue accounts. You cannot just say total revenue. Okay? Otherwise, your revenue accounts really are not closed out, are they? So if you have 3 revenue accounts, it's going to kind of look like this. If you have 100 revenue accounts, you're going to have 100 debits. Okay? You've got to list out every one of your revenue account. Keep in mind something else as well. Looking at the ELMO, this is not a financial statement, guys. This is a journal entry. This is a journal entry. This is the debit column. This is the credit column. Okay? Sometimes students, they mistakenly think I'm doing some sort of little financial statement here. It's not that. It's a journal entry. It's a closing journal entry. Make sense? That's the first journal entry. Okay? All right, what was the second closing entry? Close the expenses. Now, do expenses normally have debit or do they have credit balance accounts? Expense accounts, are they normal debit or credit balance accounts? They're normal debit. So what do you think we have to do to all these expense accounts to close them out, to zero them out? We have to credit them. Okay? So our second closing entry. Now I know that I'm going to debit income summary. For the total of all your expenses, okay? But and then I'll have a bunch of expense accounts. Okay? And those will have certain balances, correct? Let's just say the total of all of our expense accounts is $45,000. Okay? You with me still, guys? You have to just simply go through your adjusted trial balance, the trial balance after you've made your AJEs. Got to look at each one of your expense accounts. You're going to credit each one of those. Okay? And then the total will be debited to income summary. We're not too hard yet, are we? Still good? Okay, let's do the third closing entry. Now, the third closing entry, well, before we go to that, let me ask you this. Can we look at what we have so far, and can we tell if we have a net income or a net loss situation? Net income. How do you know that, Brian?
80 minus 45.
Right. Your revenues are greater than your expenses, right? So here's how you do the third closing entry. You need to, first of all, do a T account for income summary. Now, income summary is a temporary account. It starts with a zero balance. Here we credited it for $80,000, correct? Here we debited it for $45,000. What's the balance of income summary? 35,000 credit balance, correct? Now, in this situation, we had a net income, right? Could you ever have a situation with a company where the expenses were greater than the revenues? Certainly you could, and that way, then in that case it would be a balance over here. Okay? Okay, that is our balance of income summary after we post the first two entries. If the third closing entry is to close income summary, what do I have to do to income summary to zero it out? What do I have to do to this T account? I have to debit it, right? Now we have a zero balance, correct? So this third entry, don't try to shortcut things. You have to do this T account to do the third closing entry. Well, if you want to do it in your head, go ahead. But I have a lot of students who said they try to do things in their head, and then when I grade their test, they got it wrong, okay? Because they make silly little errors, okay? So do what you want. Do what you want. But I always encourage, I still always just, this doesn't take that long to do. But I also like you to do it because I truly want you to understand what we are doing here, okay? We're going to talk about that here in a few minutes. So I need to debit income summary for $35,000. So our third closing entry, I debit income summary for $35,000, right? And what do I credit? I credit capital. I credit capital. Now look at these three. I know we have one more closing entry. We'll get there in a second. Do you see where these closing entries are in a sense kind of flushing the net results of the revenues and expenses and net income into the capital account? And the capital account is kind of an accumulation of past periods' net incomes or net losses. Does that make sense? So we're kind of summarizing everything into the capital account. After we do these, the revenues, expenses will all be reset to zero. And we can start recording things in them again. But periodically, what we're doing is we're just closing or flushing in everything into the capital account. Now let me ask you a real quick question as we look at these three journal entries on the monitor. Brian, you were correct in saying that we have a net income situation here, don't we? Now, does it not make sense what is happening in this third closing entry? Is capital a debit or a credit balance account? It is a credit balance account. So in that third entry, Zach, is capital being increased or decreased? It's being increased. Does it not make sense that a net income increases capital? Thinking back to your statement of equity? That should make sense, right? Should make sense. Okay? Now, certainly, if we were in a situation where we had a net loss, this entry would be switched. Capital would be debited and income summary would be credited. Okay? But the number that goes in this third entry is derived from doing that T account. And that T account, of course, is from the first two closing entries. Does this make sense? Okay. Let's do the fourth closing entry. The fourth closing entry is to close the withdrawals to the capital account. Now, is withdrawals a debit or a credit balance account? It's a debit. So if I want to zero it out, what do I have to do? I have to credit it. So I will credit it. And it's for whatever amount. And then what do I debit? It's not income summary, but it's capital. Now, let's look at that fourth closing entry. This should make sense as well. Zach, you told me correctly that capital is a credit balance account. Thus, when we are debiting capital, are we increasing it or are we decreasing it? We're decreasing it. Does it not make sense that, looking at that entry, does it not make sense that withdrawals would decrease capital? Isn't that on the statement of equity that we see that? Okay. All right. Somebody might ask, what is this income summary account? Now, hopefully I've trained you pretty well to this point where when we have a new account being debited or credited, you ask yourself, what type of account is this? Is this a debit balance account or is this a credit balance account? What financial statement does it go on? Da, 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 da. Okay? Well, this one's kind of a trick question. And you can come off those journal entries. Income summary is not any type of account, and it doesn't go on any financial statements. And if you ask, is it a normal debit or a normal credit balance account, it's really neither. All income summary is this. Sort of. All income summary is a T account that we utilize when we do the closing process. It has a very short life. It has zero balances when we start the closing process. We close the revenues to it, we close the expenses to it, and then we close it, and then we put it away. Okay? The thing and some students have astutely said, why don't we just close revenues to capital and then close expenses to capital, and then we don't need an income summary account. Well, you could do that, but one thing with accounting is we like to make as few of journal entries to capital as we need to. And by using an income summary account, the only amount that gets credited to capital is the net income. Okay? So this is the way that we like to do it. Income summary is kind of like a mixing bowl when you make cookies. You throw all your stuff in there. You throw your brown sugar and your flour and your chocolate chips and your butter and your vanilla and whatever. And then you mix it all up and then you take it out and you cook it, right? Now, could you make cookies without a mixing bowl? Yeah, you could. It'd be messy, but you could do it, couldn't you? Just like you could close without income summary, but we do income summary just because it makes it a little cleaner. Does this make sense? Now, let's look back at those 4 journal entries. I want to talk about something that pertains not just to closing entries, but pertains to all of what we're doing. I want you, do you remember how I talked through these as far as what do these really mean? Well, revenues have a credit balance account, so to zero an amount, we have to debit them. Expense have debit balances account, so we have to credit them to zero them out. And then we talked with Zach about how this is a net income situation. Thus, it should make sense that capital is being credited when we close income summary, right? And we talked about how withdrawals is a debit balance account. Thus, if we want to close it, we have to credit it. And it should make sense that capital is being debited because capital is a credit balance account. Thus, when we debit it, it is being decreased. But do you see how I can just talk through this and it should make sense? I'm giving you the reasoning behind what we do. I'm giving you the process behind what we do. Why do I say that? Because there are students who make the mistake looking at these entries of their rationale is, I don't know what the heck he's doing, but I'm going to memorize what these 4 crazy journal entries called closing entries look like and do. You see what I'm saying? I don't know what he's doing, but if he wants me to write them in that way, I will do this. And they literally just memorize what goes where. Okay? Now, I asked one of my students to write my name in Chinese before class, and here's what it looks like. Okay? Here's what it looks like. And that's my name in Chinese, right? Now, let me ask you this. If I really put my mind to it, could I learn how to write my name in Chinese? Yes, I could. I could say, okay, that must be a D. It's not bad, is it? This, let's see, I'm already messing up. Okay? And then I don't know what's going on here, but if you want me to try to imitate that thing, you see what I'm saying? Now, I might be successful in writing my name in Chinese. But all I'm doing is I simply memorized what this student wrote down and I duplicated it, right? Now, if somebody says, that's cool, David, that you wrote your name in Chinese. Can you write my name in Chinese? Well, I can if their name is David, right? But what if their name is Leslie? Do you see what I'm saying? I can't learn how to do Chinese by simply memorizing that. I might be able to fake it, but I really don't know what's going on, and as soon as it's changed up a little bit with a different name or something, I'm sunk, correct?
You would learn something, though. You would learn, like, the certain letters in your name, what they are.
But would that be the optimal way to learn Chinese? No, it wouldn't. It would be a very, very slow, arduous process. Okay? And I mean, and the thing is you ever heard the saying, a little bit of knowledge is a dangerous thing? Okay? I would have a very, very little bit of knowledge. And certainly I don't understand Chinese, even if I could fake it. So, when you learn something like closing entries, don't just memorize what goes where and what we're doing. Okay? Because if it gets changed up at all, you're not going to know what you're doing. Okay? Here's what I want to do real quick. For you folks at home, please do this as well. I want you to turn to exercise 4.2 in your books. It looks like this. I want you to ignore the instructions that they give you. Ignore them. What I want you to do is to prepare the 4 closing entries for this situation. Now remember, they list out some permanent accounts like cash and accounts payable. Do we close those accounts? No, those are permanent accounts. So I want you to do the 4 closing entries for exercise 4.2. Let's do that real quick, okay? While they play the music, you folks at home, you do as well, all right? See you in a few. Okay, let's come back. If you folks at home aren't done yet, just pause and try to finish it up. But if you are done, let's go ahead and go over this. Okay, the first closing entry for this situation needs to look like this. Now, when I show you these closing entries, they need to look, what you do needs to look pretty much exactly like what I did. Don't think that, well, mine looks different, but I'm sure it's okay. Well, no, it's probably wrong, okay? It really needs to look exactly like this. This isn't like a balance sheet where, well, I just think I did it a little different way. No, what you do for closing entries needs to look pretty much exactly like what you see, okay? So that is the first entry to close. There's only one revenue account, okay? Then we close our expense account, okay? Then we close our expense accounts. Now, the only thing you might have done differently is list those in a different order. But otherwise, it needs to look exactly like that. You can't say total expenses or whatever. You need to list out each expense and the balance necessary to close it, or the entry necessary to close each expense account.
Why can't you just do total expenses?
Because this journal entry is kind of like telling us to go to each one of these accounts and put a credit in the T account on the depreciation expense, to put a credit of 33034 in the salaries expense. Do you see what I'm saying? So that's what journal entries are. They're saying you need to go do this to the ledger, the T accounts. Good question, though. Now what we need to do, before we do the third entry, do your T account for income summary. And I did it real quick. There was a credit of $83,000 from your first closing entry, a debit of $64,701 from your second one. Thus, we have a balance of $18299. Thus, how do we close out income summary? What do we have to do? We have to debit it, and thus our entry looks like this. Okay? All right? Now, did anybody accidentally make the mistake of somehow in this third entry looking at what the capital balance was of $66,701? Did anybody make that mistake? Okay, don't do that. We're not closing the capital balance. We're closing the income summary to capital. Does this make sense? Okay. And then our fourth closing entry is we close withdrawals, $14,400, and we close it to capital. Okay?
And then that's all equal to all on the balance sheet, right?
Well, we're going to talk about that in a second. We got about 4 minutes here, and I'm going to use every one of them. Okay? So it's a good question. Okay, now if I asked you in this situation what your ending balance of capital is, what you would have to do is do a T account. You would have to take that beginning balance of capital of $66,701 that was in your book. Let's see, is there any debits or credits to capital? No, not this one either. Here we have a credit of $18299. Here we have a debit of $14400. And that will give us thus a calculated new ending balance of capital. Are you with me? Why do I say that? Because going back to the PowerPoints, I want to show you one last thing here real quick. And you can look through your PowerPoints and see another example of an adjusted trial balance that they did closing entries for. Okay? Just like we did. But then I want to show you what a post-closing trial balance is. A post-closing trial balance is after we do the closing entries, and it is simply a list of all the permanent accounts and their balances after we post those closing entries. The total debits have to equal the total credits. And what is that going to look like? That is going to look like this for the example in your PowerPoints. Now notice a couple things. Are there any temporary accounts listed on this post-closing trial balance? No. The only reason we do this is to make sure we didn't forget one. Let me ask you, would a statement like this be helpful to help prepare financial statements? No. Why? What is the first financial statement we prepare? Income statement. You would have a really difficult time trying to prepare an income statement only looking at your post-closing trial balance, right? Because your revenues and expenses are all zeroed out. So you prepare your financial statements after you have your adjusting entries and your adjusted trial balance. That's when you prepare financial statements. But this is a post-closing trial balance. Do the total debits equal the total credits? Yes, they do. And see that capital account? How did they get the balance of that new capital? They did exactly what I showed you earlier. They put the beginning capital balance in a T account, and then this third and this fourth closing entry that has entries to capital, they posted those and then figured out their new ending balance. Erica.
So when you do the post-closing trial balance, you don't use the capital that's on
No,
the first one,
that's a
you use
great
that?
question. When you do the post-closing trial balance, the only place that you use that is for your beginning balance. That's where you use it, okay? To put your beginning balance in there, and you can see on exercise 4.2 that that's the beginning balance of capital. But then you have to take your third and fourth closing entry and post those and get your ending balance of capital. Otherwise, you know what? On your post-closing trial balance, your total debits won't equal your total credits. Okay? So in our homework, when you do a post-closing trial balance, take a look at the example on the PowerPoints, because I know we had to hurry through this a little bit. But if your total debits don't equal your total credits, chances are you haven't adjusted to your new capital ending balance. All right? Okay. Let me give you your homework. And I know I kept you a little over. I want to give you your money's worth today. Okay? There is the homework. Have that done by next period. And remember, we're getting close to having a test. Okay? So you might even start studying for that. All right, folks. Why don't you go ahead and put that back up? Oh, it's up there for these folks. Okay. All right, that is it. And I will see you later, guys. See you next time.